It's been a brutal year for capital markets. The S&P 500 looks like it'll clock in its worst year since the 2008 crisis. Bonds have plunged, the dollar has surged, and crypto has crashed. So what can investors do? In this interview, Hari Krishnan poses that question to the so-called asset capitalist and widely followed macro manager, Hugh Hendry. The two sit down to discuss actionable ways to create long volatility exposure in the current market regime. Enjoy.
So it's a pleasure to have Hugh Hendry on the show today on Real Vision. To give an extremely brief background, he's the asset capitalist, former macro hedge fund manager, maybe still one, a marketing personality, and a haberdasher, a media personality and a haberdasher, for lack of a better phrase. It's a pleasure to have you on, and I thought we could talk a little bit about what's going on in the world and maybe some ways to play those ideas as you see them. So we'll start with something really simple, which is proposing a big toast to Ben Bernanke, our distinguished winner of the Nobel Prize just the last week, which brings us straight to the Fed. Now, let me give you a multiple choice question regarding the Fed. Here are the four choices. The Fed can jointly control its currency and can control output and inflation together. The levers of monetary policy are effective to an extent, but they operate with lags that are unpredictable. So you have basically a complex system. The Fed can't control anything overseas. That's number three, but maybe they can do stuff within the US. And number four is that other than public perception, they can't control a single thing. Do you want to pick an option and maybe expand upon that?
For sure. I think first things first. Let's get rid of the silly hat.
That's a good throw.
Is that potpourri? Can I dive in and take a little bit?
You can do what you want. You can do what you want.
Because you cited complexity. Our system is complex, profoundly complex. I think you made a distinction between onshore and offshore. And I think at the essence of your question was to choose between the perception of omnipotence on the part of the monetary authorities.
Yeah, fine word.
And a lack of. And I'd very much select a lack of. I want to take your question and start again with the notion of three forms of money, which I think are poorly understood by the many. And let's start the first one, and let's call the first one the one that's most widely recognized. And let's call that a symbiosis of the public and the private. And that would be, that's the sovereign monetary system. That is the domestic banking system that occurs within the sovereignty of the United States. The purview, the regulators, the Federal Reserve. The deposits are insured by the Treasury. And once upon a time, that was the system, by and large. Today, I'm less sure. Today, I don't know if that accounts for more than half of the system. And that system has not been exuberant. That system's ability to generate money or credit, dollar money, has not been exuberant since essentially its near-death experience from 2008, 2009. I think previously I was on a show and I said Citigroup traded at $7 or $9 in March of 2009. And I chose Citigroup because back then it was kind of Jamie's, JP Morgan today. It was the one globally, the major bank. It wasn't $7 or $9. It'd been, they had a share split because I think it was 70 cents.
Yeah.
It was the same price as it traded in the mid 1970s, and whatever it traded for, it was too much because it was bankrupt. That's kind of cooled the ardor of the domestic banking sector to print money. Okay, and the printing of money is going to become very central, I think, to the conversation that we're going to pursue. Because, in the last week or so, we discovered that UK prices, CPI, growing at 10%, and a little bit less, but still in this 8 to 10% range seems to be global. And if we were to try and reduce a profoundly complex system to some simplicity, just thought of it as a wallet that had money creation coming in, and it had like the strain of CPI in the mix to create what was spent. If prices are, if we take the UK instance, growing at 10%, then we require an additional 10% to come into the portfolio, to come into the wallet, to furnish the same level of absolute spending as the previous year. And so we're looking at, I'm saying to you, I've got 3 sources to generate that 10%. So we've done the first, the sovereign controlled form of money, private money printing. The second, because the first has been in, let's call it abeyance, we've had this pure form of public money, which are these banking reserves, which are the reciprocal of buying treasury bonds, and we call it quantitative easing. And back to your list, this is the manifestation of an illusion. This is, hey, look, and when times were really fearful during the pandemic, Jay Powell, the chairman of the Federal Reserve, was on daytime television. He wasn't wearing a tie, and he was reaching out to the ordinary folk, and he's saying, guys, I know it's scary out there, but I'm here to tell you, typically the most scary words in the English universe, lexicon. I'm here from the government. Yeah, I'm here to help. Really?
Right.
Yeah, I'm printing money. I mean, liar on, pants on fire. He literally said he was printing money. Now, that would actually be a federal crime. No one's yet knocked on his door. But politicians have certainly knocked on his door as 12 months later and whatever, we saw this elevation in pricing. But that's what he was referring to. Banking reserves. Now, banking reserves, I said to you, it's a pure form of public money. To actually become money creation, it requires the intervention. It requires its power to persuade. It's latent money. It requires being latent. You're trying to persuade other economic actors. Again, back to the banking sector.
So I can't go to the store and spend bank reserves.
I've been trying, as hard as I try.
Have.
I'm in Starbucks and I get a coffee. I'm like, hey, how many bank reserves is that? So it's it's laundromat tokens. It's I like to say it's American Pie or whatever. The parents are leaving town. The parents are off to Vegas. And they've got teenage kids. And normally you lock down the liquor cabinet, but instead you filled the garage with beer. And you're like, kids, this one's on you. From the parents, have fun, right? But the kids are like, remarkably, kids are like, not this weekend.
Yeah.
Okay.
But if all banking were onshore and all banking were actually based on fractional reserve mentality, then this system could potentially work. But both of those hypotheses fall woefully short. Exactly,
and that's why we have to talk about the third form, which is, if we discuss pure public, let's discuss pure private. And the pure private comes under many names, repo, Eurodollar. Let's call it the Eurodollar system. But it's essentially, it is a system which evolved to replace the inadequacies of the Bretton Woods system in the 50s and the 60s. And it evolved by the private sector. And it evolved outside the sovereignty of regulators, bank regulators, and banking systems. And it's a system which, it's a ledger system, but it's an unconstrained, I want to say unconstrained in that there are no limits except the limits imposed by your reputation. Like your line of credit is good as long as you don't mess it up. You mess it up, so you do have a sharp pen on your spine. You mess it up, and that money's being, this is 24-hour lending.
There's also a massive game of chicken, isn't it? Where there are really no constraints, there are no reserves required. But if you think someone else is in trouble, or if the perception is that another large entity may not be whole, then the whole system comes collapsing down because you've got your risk limits, you've got your risk teams, and you don't want to be exposed.
Exactly. So effectively, I mean, only the genius of the private sector could conceive of this. They've conceived of, so think of the Fed and its control of inflation and the prudential activity of the US banking system. And effectively, it is the, what do you call it, the airbag. In the event of a crash, boom, you're saved, effectively. The private sector created something much better. It created, essentially, a sharp dagger which protrudes from the steering wheel. So actually, whilst you're on risk, you're conscious of risk. Doesn't mean to say you won't crash, but you're more conscious of the risk-taking. Yeah. And because the consequences are severe, because like you say, this is a reserve-less system. This is like maximum pure octane leverage, right?
Yeah.
And so you focus, but it means it's very quick to pull away owing to that form of regulation. Now, that's now where we get to the point. The Feds, in their communication, seem to, and I fear this is the case, I hope it's not, they just don't seem to recognize non-sovereign money. And the hiking cycle just now, my fear of it is that it's happening oblivious to what it may unleash offshore, if you will, in this reserveless system. That's my profound fear as I spend some of my waking and thinking time in the future.
But, I mean, how can the Fed know the size of this system? Do they know the size? Do they have any notion of the amount of sort of fractionless lending that's going on overseas in dollars? Is there anything they can do other than look at indirect measures like just the strength of the US dollar, the ongoing bid for securities that may be posted as repo collateral and so on? Is there anything that they know more than this?
Well, I mean, hey, let's contextualize firstly, okay? I think the task in calibrating the size of the offshore market is less than the task that Elon Musk has set himself in terms of reaching Mars. Yeah.
Okay, but both might be undoable, but yes.
Well, both might be undoable. But you're right in the sense that the offshore market is like phantom money. We only know it exists. It's like the wind when it touches your face, kind of thing. Wow, it's windy out there. Yeah. And so we get a sense of it as it touches asset prices. And therefore, it's not a huge ask for the Federal Reserve to be cognizant of much time is spent on the fears of debt to GDP, the stock to stock ratio, without consideration to the fact that partly it's elevated because of the unprecedented wealth to GDP.
Yes, yes.
However, we do know that from time to time, our private sector gets a little bit too enthusiastic in its appraisal of the future, and it creates fictional. Now, I'm saying fictional, I'm not saying fraudulent, I'm saying overstated, but it's fictional wealth. And there are points when the fictional wealth has to be removed from the system. And so I want to say we got to about 7 times wealth to GDP, assets to GDP, and that's unwinding. And we kind of know that when you unwind, when you lose, when you vaporize like 1 times GDP, there are economic consequences, which is to say you have a severe recession, which is measured in 2 to 3 years. And what if we talk about it going from 7 to 4 times? You know,
it's massive.
That's massive. And then what if that's occurring during a depression? And people will laugh at that. Say, get out of here. Depression, look at it. You're like the Fed. I mean, the Fed won't even recognize that we had 2 consecutive quarters of negative GDP, which is forget depression. That's a recession. Oh, no, it's not. It's not. I'm like, what? I mean, as long as I've been on the planet, it's been a recession. No, because the labor's really tight. Get out of here.
Hi, I'm Raoul Pal, the CEO and co-founder of Real Vision. The financial world is a complicated world right now. It's a really complicated macro picture, and there's a lot of risks. Real Vision and our YouTube channel help you navigate those risks. So subscribe now to the channel and never miss an update. There is simply too much going on. So subscribe now. Thank you.
You know, we haven't used the word inflation yet, which I think is quite good given the amount of times it gets bandied about. Are we actually in an inflationary period, or do we just have a supply shock that's driven prices up in the short term and the Fed is overreacting to something that's coming down already?
I favor the latter, and the precedent for that would be the 1948 experience.
I don't remember that one, but
oh, you weren't around then. No. Okay, no, well, let me tell you, that was a screamer.
That was a trip, yeah.
We had, forget today, we had U.S. CPI touching 20%, and we had the Federal Reserve pleading in front of Treasury committees to be given extra powers to pull this thing in. Otherwise, the entire integrity of the U.S. financial system would clearly be called further and further into question. But like you say, you don't recall it. You don't recall the great inflation of the late 1940s because it didn't persist. Why didn't it persist? Because again, we have this commonly accepted statement that inflation is, and always is, and everywhere is, a monetary phenomenon.
Milton Friedman's back in vogue. I can see that.
Well, he's back in. He never went out of vogue in my head. I've been voguing Friedman for some time. Okay.
Yeah. Okay.
But instead, Volcker's replaced Friedman, and it's all this kind of we'll show you.
Yeah.
Now there's central banking reputations are contextual, right? Volcker could have the caricature of being the tough guy, because we've completed 4 decades of deleveraging. The deleveraging set in store by the bankruptcy of the US banking sector in the early 1930s. The society said, we don't wish to be subject to this anymore. We wish our banking sector to deleverage. That takes a considerable period of time. But if debt is approximately globally 4 times GDP today, it was approximately roughly 1 times, give or take, a decimal point in the 1970s. And you can be a hard policymaker against that environment. I want to say that it might be that 5% could be the terminal peak Fed funds rate in this environment if you work on the basis of 1 times debt to GDP with 20% rates where they peaked in the 70s, and 5 times 4 takes you there. Now, regardless, the 20 and the passing of it set in store a 50-year bull market. Believe me, the passing of 5 terminal with 4 times debt to GDP, I fear, will actually set in store a further profound deflationary bust on a par with 2008, which we know ultimately, they'll deny it, but the political pressure will be so intense that we haven't seen monetary misadventure yet. We've just seen monetary myth-making with quantitative easing. But if I'm right and we get a further deflationary bust, you're going to see monetary misadventure, which will ultimately uncork the bond market.
But there's some perverse things that kind of bend my mind in this space. One of them is... and I talked to Michael Howell about this some time ago. And basically, the idea is maybe there's 350 trillion of outstanding debt globally. 70 trillion has to be rolled over from year to year. And yet there are only, at least until recently, there were only about 20 trillion of marketable treasury securities that could be deployed as collateral in rolling over that debt. Now, what that implies is that every time the Fed engages in QE, They're actually sucking treasuries out of the system. And now that they're doing QT and treasuries are rolling off, if you assume that there'll still be a decent bid for them, which is a giant if, you've actually eased conditions in some perverse way because there's more stuff to go around and be bought that can then be used or deployed as collateral for international repo transactions. Is that too convoluted, or do you buy that
Well, it's
strange
not
argument?
It's not convoluted, and it was actually validated by a pivot by the Federal Reserve in 2020, which was that very point, that the last iteration of and again, you have to question quantitative easing when it has iterations. Iterations means the first one didn't work.
Yeah.
Means the second one didn't work.
Right.
Japan's on the 27th iteration. Maybe it just doesn't work. Okay. But in the kind of funky, idiotic iteration, they weren't buying duration. They weren't buying like 10-year maturities. They were buying bills.
Yeah.
And that was just acute. They were just taking out high-powered money
Before twist.
from those offshore non-sovereign markets. So I think that action in itself validates your point. However, so that would prove respite to my fear that we could have a deflation, that paradoxically that quantitative tightening actually would be providing more collateral for a collateralized,
more stuff to
for a
lend with.
repo market to be leveraged. The thing against that is implications for asset markets, because we're presently, the repo man's out there and there's taps on the shoulders. So the market risk-taking had been ebullient for 9 months of 2020 and 21. And the consequences of that were the offices at the collateral window weren't insistent that you delivered 10-year treasuries or 6-month treasuries, that they would accept BTPs, they would accept a whole host of things, high-quality corporate bonds, arguably high-quality equities, you name it. They were in a generous mood. They were clearly accepting British gilts. And again, this system that knows no name, that can't be quantified, except when it touches, when the wind passes through. Well, it clearly passed through our world, and we saw the devastation that it can wreak 3 or so weeks ago with the British gilts market, where the repo officer said, "Your gilts are no good. You give me something else."
Yeah.
And again, this comes back to, and maybe it's for later, but this is the fundamental factor I think we believe is driving the strength of the dollar. It's got nothing to do with interest rates.
Yeah.
And it's got everything to do with the enormity of that banking system and switching again to say, I require the surety of dollar-based bills and other maturities. And I would ask you to replace your gilts et al. With that. And so at the margin, you're selling sterling and you're buying dollars. If it's BTPs, you're selling euros, you're buying. If it's Japanese bank reserves, etc., you're selling yen and you're buying dollars.
But should it be security and credit or liquidity? Because if I accept your treasury bills or your treasury notes as collateral for a loan, the loan's going to be short term.
24 hours.
So I don't really care if it's a somewhat bad credit in the medium term. I just care that I can sell it tonight or tomorrow if I need to. So isn't there some kind of blurring in the lines between, although they're correlated, between creditworthiness and liquidity, which is actually the more important factor?
Oh, this is the number one. The number one issue is liquidity.
So if treasuries became illiquid, for whatever reason, the whole system would come crashing down.
And so treasuries are becoming illiquid.
So I've read, yeah.
However, they are still underwritten, and they should be. So for all one's misgivings about the Federal Reserve, again, when you return to its kingdom onshore, it does recognize central banking principles like BACOD. It represents the notion of lender of last resort, the need to be liquid to stand behind the US Treasury market. And that will happen again.
But I thought that notion was that you lend at high rates if you were the lender of last resort, not that you cut rates and let the system just expand as a function of that.
Well,
You do lend, you're willing to lend. You don't lend at extortionate rates, but you don't lend necessarily at extraordinarily low rates.
you're just the marginal buyer. Again, has our system become compromised, or backward? I mean, which year do we have to go back to? Which century do we have to go back to? You're probably wearing a wig. I am not wearing a wig.
I might need to one of these days.
But it predates the First World War.
Oh, easily, yeah.
Of
I think
course,
it's
yeah.
1800s.
But I cite the First World War because it required the enfranchisement of everyone. That up until the First World War, the politics and the world was run by an elite. Now, we will certainly discuss the elites of the IMF et al. To the point I don't think we fully covered, the Dadaism of awarding a Nobel Prize to Bernanke for his insight, his foresight, forgive me, the guy who said, mortgage-backed securities problem here. No, not a problem, don't worry. Boom, worst economic downturn ever. Don't worry, no. Hey, take a bobble, you're the wise guy. I mean, they are so assured of themselves now that they can be that idiotic. Oh no. And the elites just kicked out the British Prime Minister.
Yeah.
Yeah. Now the press will tell you that was she lame? Yeah. Am I going to sit here and be, hey, Liz Truss? I want to tell you, as many of you know, I gave up on the political economy from my skirmishes in 2010-11 during the European sovereign crisis. I was a kind of perpetual guest on the BBC and trying to take on politicians and the like. But I gave up on that. I moved to an island in the Caribbean, a collectivité, which has actually positive cash balances, where there's no income tax, no corporate tax. There are taxes, where there's infrastructure, well-funded infrastructure, and no crime. Sadly, you find that on a rock which is 21. We can organize our affairs on rocks of 21 kilometers. We can't organize it further. But to the point of, I think, the Bank of England and the IMF. So again, my point being, we have been chained into a depressionary environment, which is to say that whilst nominal GDP levels have surpassed the highs of 2006, 2007, we have categorically failed across the world, with the exception of China, and that's something else, to retain the growth rate in the economy, the growth rate in prosperity, which had characterized the last 40 years. What is missing? Something's missing. That vector point, that failure, which each year now...
Well, didn't we outsource the growth to Asia and then make up for the shortfall with credit expansion? Isn't that the story of the last 40 years, roughly?
You're teasing me. You're teasing me because we're still trying to get closure on the last question. Now you just opened up
I can't help myself.
huge...
I can't help myself.
Well, to that point, I lament. I lament on the lost opportunities. So the mercantilist system has been, essentially the central government in China has been robbing wealth from its personal household sector, enriching itself, and then taking that wealth transfer and parking it into US treasuries for liquidity, and because it's the only one kind of open, it's the only one that would accept them, that scale of money and that scale of disturbance to the political and the domestic economy. I'm trying to touch upon that. So it doesn't trust its domestic citizens to spend the money. And instead it farms it overseas and it goes, ta-da, please spend. And we know in that in the 8 years running up to the housing crash in 2007 and 8, China deposited $5 trillion worth. Okay. Now, if only it'd been the 19th century and America was building canal, and we put all together canals, 3 railroads going to going to the same destination, that we had a burgeoning chemical sector, we were about to roll out, fixed line telecoms, then that $5 trillion would be very, very welcome.
Yeah.
Except today, the economies with trade deficits are countries where domestic investment needs are well covered by the domestic savings pool. And so the $5 trillion comes in and it breaks market-based pricing. Market-based pricing, which is an interest rate, is there to calibrate creditors and debtors. Creditors would be Apple with their huge cash. They don't require much money to sustain or to move their business forward. It would be China, it would be Saudi, it would be the oil companies, It'd be everyone that has got pockets full of money. And the system brings them together with the debtors, which would be the Steve Jobs of lore, the guys, the girls in the garages that are going to change our world. Full of crazy ideas, don't have a penny. And the market-based system brought that together. And we just crashed that system, absolutely crashed that system, where now we have zombie companies, we have asset price inflation, where we don't have entrepreneurialism, we have speculation on asset prices.
Well, I find it puzzling, the Fed, the New York Fed often puts out pieces about the term premium or the negative term premium for the yield curve, whereby the average of the 1-year forward rates is actually far higher than the 10-year point, let's say, in the yield curve. Is that just an argument that the system's broken because you don't get compensated for taking duration risk? I mean, the old paradigm, if I have a textbook at home, honestly, and I open it up and it says that risk is based on duration as much as anything else. Vol and duration. And I haven't believed that for a while, but I'm curious as to any productive thoughts you may have in that direction.
I don't know if I got productive thoughts, but I can certainly riff off that.
Yeah, you can. Riff off that. That's good enough.
Because something lit up one of the things you said. You have these textbooks, and they tell you how the world's supposed to work.
You get compensated, right?
And
taking time risk.
I'm a macro guy, and the Bible was manias, panics, crashes, et al. Kindleberger.
Yeah.
And it was dope. I mean, it really worked until 1999, until the end of the last episode of it working essentially was the Asian tiger crisis. Hasn't worked. Has not worked. Nada has not worked. And again, back to this notion of displacing trusts and our chancellor and stuff, which is IMF rhetoric. The IMF doesn't work. I mean, it's a joke. I mean, it's easy for me. I'm a joker, so jokers pass these things. But seriously, tell me the last time you saw a statement from the IMF, you thought, wow, yeah, those guys, those girls, they're on it. Rapier. Who gets a job at the IMF?
Well, it's a bureaucracy, effectively.
And it's a political bureaucracy. They have to be very mindful of the language they use when look, they can't say anything about China et al. So something stopped working in the last 20 years. And I'd come back again and I'd lay the charge that it was mercantilism that stopped the models working. So I was saying lament, the $5 trillion parked into the US. The US should have invested it. The Treasury should have gone China-esque and just said, you know what, let's improve the road system. Let's replace these bridges. Let's have new airports, etc. Right? We're in New York. I traveled down from Boston yesterday. It took me 4 hours. Now, it was gentle, and it was nice. But then, cars were over. I mean, guys on,
I might have been on the same train.
slow. And per capita GDP between Boston and New York, what is per capita GDP between those two conurbations?
It's quite wide, I would think.
But I mean, the average figure, we're talking minimum 80,000. I would say 120,000. Do I have takers? Are we higher? Are we going to settle on 120,000? Boston,
I'd take the
Boston
low
into
end.
Manhattan.
I'd say more like 80, but...
Okay, I'll take your 80. Bid's closed. 80,000. Per capita GDP, China, 12,000. Is it even 12,000? Actually, did I see a figure that's 8,750 or no? Because they're now a mid-country, so they got 10,000. So, let's call it 12,000. 12 versus 80. The GDP calculator is starting not to work. When they put in 5 in China, 3 comes out and they're like, what? Normally put 5 in and like 5.5, 3? Really? Let's delay that publication,
Yeah.
And then you've had this magnificence of GDP growth for 20 plus years and a stock market which is flat. And again, I've got a tax book, I've got a stock market book back home, and it says stocks should be like, what do you want? So the answer there is you can have any GDP growth you want if you're willing to sacrifice wealth. And the Chinese have sacrificed wealth, and the telltale sign is the debt to GDP. The stock reflects that. The stock market reflects that. And why are you not creating wealth? Because they spend the $5 trillion that the US should have spent moving people on $80,000 per capita GDP, moving them quicker, right? That actually if I can save 15 minutes out of the working day life of someone earning $80,000, the utility will be reflected in economic gains, which will more than offset the cost of that infrastructure project. Now consider the same cost, but I'm moving people on $10,000, probably less because typically it's to a conurbation where it's 10, call it 12, call it 15, to somewhere where it's 4. That's why there's no wealth creation. The tragedy, and so the thing not working is that opportunity was passed. What the US did instead, Wall Street created $3.5 trillion of mortgage-backed security. The Treasury government create the period 2000 to 2007 created $1.5 trillion of treasuries. But we just put 5 in, and we're looking to buy safe, secure treasury assets. And not only did the Chinese, Germany, of course, put in a mother load. Japan put in a mother load. Korea and the domestic wealth sectors want to buy those things. Well, what do we buy? Wall Street's like, oh, well, we've got this thing. We collateralize, we bring mortgages, we diversification, we sell you the security. Anyone interested? Everyone's like, yeah, sure, boom.
Yeah.
So we had a profound housing disaster where we could have had, who cares if it didn't generate wealth? Can you imagine we spent the last 10, 15 years just building stuff like infrastructure in America? Would it be so much worse than where we are? I mean, that's the lament of where we are. And that's why Kindleberger et al. Haven't worked. And then the fascination that it's fed QE, which has fed those asset prices to the moon. It's the $5 trillion from China, which destroyed the pricing mechanism. Your fact, the term premium's not working, nothing working, except, we were at a point where there was so much global treasury selling at negative yields. And if you discount that, if you find a business like Apple, which is deemed to be it's a preposterous assertion to be riskless. No commercial entity can be riskless, but there are shades of gray.
Yeah.
And without a doubt, Apple would take you further in that direction of riskless. Well, in that environment, it becomes art, that it's riskless, is priceless, is unbounded. And that's a really good point, because we are talking about inflation, and we are talking about, I want to say, what is the dangers of the Fed's policy today. Because another book I'm sure you've read, I don't know who the author, but you'll be aware that when debt is elevated, when that stock of debt is elevated to income, the management, the solution is decades of financial repression.
Mm-hmm.
Okay. And that's my greatest complaint with regard to what the Fed is doing today, is that it jeopardizes financial repression. And I want to say to you, I think this is controversial. 18 months ago, we were in the absolute sweet spot of financial repression. That you were getting 45 basis points to own a 10-year security. You were paying $3+ trillion to own Apple. Why is that the sweet spot? Because people are like, that was the height of insanity. Yeah. Was it? Because what financial repression is all about is stealing or redistributing, rather, from the creditor class to the debtor class, okay? And for that, you require negative real rates, because the creditor class own the assets.
Yeah.
Feed them with negative. So we were there. It took us a while, but from, I want to say, 2014 up until the weak spot of the pandemic, rates were either net real rates, I want to say, were either 0 to -2 negative.
So you're saying there's a social good in that because it is a redistribution of wealth.
A necessity when debt is that level. Consider today, so real rates on the measure, if you look at 5-year tips, or somewhere between 2% real positive. Yeah. And again, let's just use this hackneyed term that US debt is 4 times GDP.
Okay.
I want to say you're transferring 8% of GDP to creditors.
Yeah, okay.
Whereas in the 5 years up to 2020, we were transferring 8% to the debtors. That's financial repression. And what happened towards the end of that, like 18, again, the Fed's like, my God, the economy's like really strong. And they started raising rates. Market went down 20% and they changed their mind. But that was kind of, ultimately we want to be raising rates, but you want to be I believe you want to be raising rates in 30 years' time, having repressed all of that debt, ensured that all of that debt got a poor return. Now, so I need the creditors. I need, it's the frog in the jacuzzi. Oh my God, is it the frog? Yeah,
the frog in the boiling water. Yeah.
Yeah, but it's better. He's got to jump out the boiling water. If you put him in a jacuzzi, oh my God, this is dope. This is fantastic, right?
Yeah.
Right? And that's where we had the creditors.
Yeah.
Right. But instead, we've created the boiling water. The Fed, being Volcker and raising rates. What's happening? Well, people are like, get me out of private equity. If only they could. They can't get out because they were stupid. I mean, bull markets make asset allocators stupid, makes them greedy, and they sign these stupid deals. Get me out of this hedge fund. Sorry, I can't. You signed this. Get me out of trade. Get me out of anything. And that's why we started with wealth being 7 times GDP, and it's coming down. So
which brings us to a semi-practical point, which is the Fed pivots, which everyone likes to talk about. Does it matter when they pivot? Will it work? Is there a trade? Is there an idea that you could put on that would extract value from it? I mean, the plain vanilla stuff would be trying to pinpoint the location of the pivot, trading options, flies, and things like that, which we can discuss in charts, but or for the viewership. But is there something more interesting than that? Because the curve is pretty flat if you go out to 2023. If you go to spring, yes, there is some implied pivot, but it's so minuscule. In my view, it shows a lack of information. It's kind of an informationless curve out there. There isn't enough structure to really say what the market thinks. It's a bit like the VIX. Not that many pros use the VIX, but the VIX term structure is super flat. It's high, sticky, and flat. It's basically saying that no one has any strong view as to when things will dissipate. As a macro guy, if you put your hat back on, how would you play that? How do you play the kind of sludgy, noisy, non-informative shape of things like the Fed funds futures curve or the VIX. What does it mean?
Why should it be informative when everything we were taught, all the today's practitioners...
Oh, the textbooks again, you mean?
The
textbooks say that there's no information, right?
You've got nothing, you've got no guide to the future. Like, nothing works. That said, so I'm not involved in the day-to-day in order to recommend trades, God forbid. But it is curious that the 2s, 10s, and the gap between them. That in itself kind of is telling you that the recession, which is going to get a lot worse, is a known entity. It's a very predictable recession. It's reflected in the curvature. But we also know, and macro is one which favors analytical review. It likes observation points.
Sure.
And there is a sine curve to that 2s 10, the drama of the 2s 10, and we're at the wides, which are suggestive of being close to kind of where you make money from a bear steepener, where i.e. that the Fed peels away. But that could also be applied to, well, let's go and buy oil or buy uranium or buy something where we think, the fundamentals with regard to supply and demand are strong. And what do I want to say? I want to say, so there's always a degree of, you have to be skeptical of your desire to do something on the observation points, because if it's slightly different, it's going to take you out.
Yeah, I'll throw another point in, which is perhaps more interesting, where there is information content, but again, I don't know what it means. So if you look at the dollar over the past few months, until the recent week or so, it's been rallying strongly. It's up, 20% against maybe the DXY is up 15 or 20% over the past several months. The pound has gotten crushed, the yen has gotten crushed, the euro's gone down quite a bit, Aussie's gone down quite a bit. But what you find is that pound downside protection is rich, Aussie downside protection is rich, but yen upside protection is rich, even after the fall. Now, I know that the yen has always been a flight to quality security. It's always been a barometer of the unwinding, sort of a credit unwinding or risk deleveraging trade. But why should that be true now? Do you have any insights in that?
I never have insights.
Perverse.
I just have party anecdotes.
Well, that's good enough, yeah. You can look them up.
Rich downside UK.
That's sensible, right?
I'd like to be the other side of that.
So you'd be short the put, long the call? Yeah, I've had people talk to me about that. It is steep. It is very convex.
There are not many instances in the life of a macro manager where you get, is it an opportunity where you get to buy cable at 1?
Yeah, now you can buy it at 116, but you collect 5 added points of volatility for selling the puts than buying the calls going out 3 months. So you break even if it goes down to 110, 105, and you're hugely on side if it goes up.
And what happens to that risk reward payoff? Because I'm not a 3-month guy, I'm a time investor, and my time goggles get all foggy at very short maturities.
Yeah, we all do, yeah.
Yeah, and I'm a 2-year. I've got I'll come into a market with a contentious narrative, which I believe can go on and grab and become the accepted belief system over a period of 2 years. If it doesn't, I'm out of there. And I've got a defined loss on it. I'm like, okay.
But you're bringing up a good point, which I think goes back to some of the macro stuff you've done over the years or talked about, which is you wouldn't go delta 1, you wouldn't buy or sell futures unless the trend was on your side. But what I'm getting is a vibe where you're saying you might take the other side using options because you'll get the natural scaling into the position that way. Is that a
never
point?
To the exception of the trend? I'm going to say this slowly. I'm an oxymoron. I'm not saying I'm a moron. That's for other people to judge. But I am a trend-following contrarian to be reflected upon. But to the point where I can say something more sensible. The profits that I earned in 2008, there was a trade-off between the Delta One and the options. I had both with regard to a bear steeper on 2's10. And just such was the torture of traveling to the ultimate, chaos. I had to jettison things from my portfolio. And I chose to jettison in September of 2007, the Delta One, just the futures position, 2's10. Right where it just went boom, and it made you a lot of money. And what I kept instead, which again is to a point you raised, was we'd been predicting doom. The US housing market was the doom trade, and we'd been predicting doom for way too long.
Yeah.
And so I swapped the Delta One for a zero carry. But I had to go 2 years forward on the 2's10. And then to my great horror, what happened was, because the Fed cut rates, they were 5.25, and did they do 50 basis points? And and it just started to get the bear steepening in the Delta One. But 2 years out, remember, back then the ECB was raising rates. Why? Because they're idiots. Yeah. And so I was on a waterbed. And the more that the Fed was cutting rates, the 2 year, again, oil was trying to go to $150. The 2 year rates, they were being bid up, and I was sinking into oblivion. So currencies are not equities, but you're trading at levels where you're at the same level. The perception of the UK at the end of the 70s was rightly grotesque, and it was on the verge of a Marxist overthrow kind of thing.
Yeah.
And it should have traded where it traded. We're kind of on touching distance of that again. I find solace, that's all I find solace in that. With regard to the yen, which I think is a far more engaging piece, because we're fed cute stories and we're willing to accept them even when they're not true. So the yen was always the carry trade. And its weakness this year is, I told you so, and the JGBs and its hedge funds in short, and they've had the zero rates and their determination to hold the zero rates in a world where the Fed now is going terminally to 5, if not higher. Well, there you go. This is easy.
Yeah.
Life is not easy.
Yeah.
And where it's beautiful is, we can talk about the beginning again of our conversation. We can talk about the latent, the laundromat tokens, whatever I want to say.
Ah, yes. The reserves.
The bank reserves. Because actually, they became active. They were called into play by Japan. The money center banks in Japan, is that the term? Rehypothecated, but they used as collateral. They went into the money market, the overnight lending departments of the Eurodollar system, and they said, we've got like trillions of these bank reserves, and I can't even quantify how many short-term JGB bank bills we have. I'm thinking, I give you that, and you give me some of your treasury bills, okay? And effectively, they're creating a dollar short. And probably there's a short they go on to create a short in terms of their sensitivity to short rates, long rates. Because then now they've got treasuries. Each night they're shifting, they've got the treasuries.
Yeah.
And because again, there's another misunderstanding. Lies is preposterous term. Misunderstanding that China has an autonomous financial system, monetary. And again, be careful when people use financial. Is it financial or is it monetary? We're talking monetary. And the Fed, actually, if you look at a lot of its communication, it has that sleight of hand. It talks about financial conditions. To understand the world, you need to understand monetary conditions. And the monetary conditions in China is it's no different from anywhere else, and it requires dollars.
Yeah, I mean, I'd like to tip the hat to Jeff Snyder for some of this stuff too, because he is absolutely legendary on the Bernanke front, among other areas. So
I am nothing more than Jeff Snyder on cocaine. I mean, I'm not advocating cocaine, but.
Well, we can talk about that offline, but just a tip of the hat to Jeff. So.
Oh, Jeff is...
not the coke, but the Jeff Snyder thing.
For clarification, Jeff Snyder.
Yeah, still focused on Jeff here, so.
I call him Jesus, and I'm... Okay, let me rephrase that. I'm nothing but John the Baptist, his Jesus. and I'd recommend everyone that's switched on to this conversation that, or any kids who are looking, the big question is, how do I get a job as a hedge fund manager? How do I get into finance? I would not accept an application from anyone who could not quote chapter and verse to the Eurodollar University podcast.
Yeah, I love it too. It doesn't get you to the point where you can stick on the trade, but it refines your thinking. It refines, a big thing, again, correct me if I'm wrong, for my years as a macro guy, was understanding plumbing, understanding the nuts and bolts of the system, understanding the machine, and not just paying lip service to it, but understanding how things worked and then letting that inform my thinking. And I think, again, this isn't an advertisement for Eurodollar University, but it's a good spot, good place.
Well, I used to, which suggests I've stopped, but yeah, I'm a paranoid schizophrenic, metaphorically, in that I hear voices in my head. And one of those voices would be Jeff. And one of those voices would be trends, would be charts. Yeah,
yeah, of course.
But then there's a syntax or whatever in my head, which is my experience, who I am, my engagement with the world. And those collide, and then I have trade positions. Today I don't have trade positions, but I am willing to go out there and risk my reputation, which is just like risking your finance in your monetary position in a portfolio. I trade my reputation to say things, hopefully bold things. And again, I'm trying to take on contentious things, which might go on to become accepted. Okay. Yeah. But obviously I become fearful. So that's the paranoid schizophrenia. Jeff et al. Charts, trend, alignment, my experience leads me to positions. And then in this word, oratory positions. And I'm, of course, the Frisian, and I do it because of the fear, which is the paranoid schizophrenia.
Which brings me to another question, and we're kind of going hither and thither, but let's say that I took someone like Stanley Druckenmiller's off-the-cuff comments seriously, which I sort of do, saying that maybe that for the next decade there'll be no return from the stock market and no return from the bond market. I'm adding that in. Where does one go? You mentioned having a longer horizon. What's to be done? I know that trend is a factor, but...
Well, again, if we take the high ticks prior to the Fed's pivot to raising rates, almost certainly the returns, the long-term returns 10-year forward on the indices, and the indices largely a function of a very small subsector of riskless securities. I would go as far as to say the returns at best would be zero. And again, I would say to you, that's what we want in terms of financial repression, to deal with, to allow GDP to catch up with debt. That question becomes more complicated because if the recession that's present deepens into a full onshore hurricane, stocks might decline 40, 50%, which is to say, again, my fear is I want the creditor class of the frog fully invested at all times so that we can fleece them. With -2 real rates and 4 leverage, I want to transfer 8% of income to the other side. And so to answer your question, what does one do? There is no salvation from public markets are just a kind of jacked up version of private enterprise. And you always have this option to move private to public to get a re-rating. So the answer is you have to be, and this is not meant to sound like a sponsorship of the private equity market. It is your own business far away from the financial promoters. There are cash return businesses. If there's always a bull market somewhere in risk capital markets, there's always a good, I live in St. Bart's, and at Christmas time, there is always a new, I guess in this environment, a new billionaire. And billionaires, they want to be the peacock, and they want to go somewhere where the other peacocks are, the other billionaires. And that same bar says, hey, look at my girlfriend, look at the size of my yacht, da-da-da-da. There will always be that. But your compensation is not found. You see, in the 70s, it was found in, you captured a lot of economic rent from the rates, from the nominal short-term rates and then rolling.
Keep churning it, yeah.
But I don't want you to, again, that was when debt was 1 times GDP. I don't want you to do that, because if you run at very high nominal rates at the short end, markets will be really weak, which is the people will be disinvested. I need the creditor class fully invested to be fleeced. Yeah?
Yep.
And again, that's why
they're subsidizing the risky asset markets.
Yeah, that's why I'm such a critic of the Fed's policy.
How about a super naive argument, but I sort of like it, which is that, let's say that there are 50 or 100 major markets that are deep and liquid that you could trade at any point in time. Every 10 years or so, or even every 2 or 3 years, some of them will move a huge amount. So why not just trade large-scale trends up and down in global markets?
Let's talk large-scale trends. 200 years political economy, and we have had 4 depressions. This is the 4th depression. Depressions tend to have a longevity of 2 to 3 decades, and they tend to persuade the young and the politically active in Marxism. Marxism was a result of the first depression, economic depression. This is 1825. This is Les Miserables talking about, it was the first time where you're in poverty, and fearful poverty, and it's not owing to the actions of the monarchy in invading another country. No, it was the London banking system having lent too much to South Latin America and calling in credit from. So we had 1825, 1865, 1930, and today. Each time it flames the argument of the permanent plateau of prosperity, where the wise move is to reject our market-based economy and pivot to Marxism. And as each day goes by, you fear that the princelings in China are making that calculation. Okay? My great concern is the unintended consequences of the Federal Reserve meddling in things like when your Google box is this size and you don't see this. It's the unintended consequences of the periphery. And what we haven't discussed is a $90 trillion mark on Chinese property, a high-tech property versus the high-tech US 36. And when it was at 36, many of us had misgivings with regard to US being at 36, never mind 90. I swear to you, China is the explanation. If Kindelberger ended in 1999, it was replaced by the presence of China in the markets. There's a notion of globalization has ended. And definitely you get that sense of the vulnerabilities in the supply chain, the fear of China engage. China should rationally engage with Taiwan because we are just embedded in their system. We can't cut them off like Russia. Just can't. 20 years' time we can. So it would not be wise for China to defer 20 years. They should do it today. And I've been pretty kind of early on that.
Well, you had mentioned somewhere else the notion of a yuan short versus USD. Is that something you buy?
Yeah. So the notion of US corporations en masse building plant domestically is a pipe dream until the Chinese authorities can be persuaded to stop robbing wealth from their personal household sector. There's the profound problem globally is a shortage of demand. And that demand is easily switched on by enriching the Chinese via their currency. Remember, if it traded at 4, I think it would resolve a lot of the macro problems of the last 2 decades. But where we are today, I fear it's going to trade at 9. Remember, it traded there in 1994. It was allowed to did it devalue? It had 2 disparate official, unofficial rates, and the unofficial was 9, and the official was fantasy 3. Yeah, and so they made it 9, and that was the solace for NAFTA.
Yeah,
and with that, remember, the US's exports to Canada and Mexico are greater than the US's exports to China, to Europe, to Korea, to Japan. There has been no upside to globalization to America. We talk about the exorbitant privilege of the dollar. This is the exorbitant burden of the dollar.
well, there is the MMT twist on that, which is that, well, I could stop there, but which is that we get the great privilege to enjoy consuming foreign goods and at the expense of debt, which is essentially limitless in its creation and in its very nature, and all is happy.
MMT would be that the 5 trillion parked in treasuries created 5 trillion of spending by the Treasury on infrastructure, and it didn't. We've never taken up the MMT is not a magic wand. You can only invest when it's likely going to expand future consumption, and therefore it will make the investment rewarding and not be fictional in terms of wealth creation. But massive lost opportunities. So my great fear is that we're heading, we're going to trade 9-10 when we should trade 4. Now, if we trade 9-10 on renminbi, we're talking about the likely denouement of the system that eventually the US would have to reject the exorbitant privilege or burden. They would come and say, this is not a privilege, this is a burden, we need a new mechanism. And we're very close. So exciting things, I think, are close at hand, but that could be a curse.
Final question, I'm cribbing this off a recent interview you gave. You're a hologram, 18 months in, well, you're a hologram now, here, but you're existing 18 months into the future. Any deep insights that you can give us? You won't be held to any of them, but...
I mean, such as my narcissism, I'm thinking in terms of personal anecdotes, which I'm going to resist. I think we've touched upon them. I mean, the legendary, now past James Dines. James Dines was the first newsletter, gold newsletter, in the early 1970s.
Okay.
And went on to make remarkably prescient calls on asset classes like uranium, et al. But he wrote these quirky psychology books, and the way not to spend a life is to devote too much time to the future. Today will keep you happy. If your anchor's on today, you will live a more fulfilling life.
The eternal now, so to speak.
Yeah, and I certainly suffer from that, and I typically find myself in unhappy domains when I stretch out 18 months forward. I don't like what I see, and that's why I come back to the present, and I'm very vocal and saying, please don't do this.
That's quite deep. I like that. It's probably a good spot to end the conversation. I've enjoyed it greatly. I hope to do it again, maybe 18 months into the future.
Thanks for watching that great interview. Here are the key takeaways. Both men agree we are operating in a complex financial system, which makes the job of policymakers very difficult. When it comes to the Fed, Hugh Hendry has a profound fear that the central bank does not understand the impact its policy decisions will have in the private offshore market, and the problems that it will cause for the US sovereign banking system. Hendry believes it's this offshore market that's driving the strength of the dollar. He says it has nothing to do with interest rates and everything to do with the enormity of the banking system and the security of the USD. Hendry thinks it's China that's completely changed the financial system over the past 20 years, and that's the reason strategies that worked in the past don't work anymore. He thinks that the yuan could trade at 4, it would solve a lot of the world's financial problems. But right now, he does like the idea of yuan short versus the dollar. When it comes to the pound, he would be short the put, long the call. He liked to be on the side of rich downside in the UK. Hendry believes the bond market is clearly telling us that we're in a recession, and has a fear that could mean even more downside for major market indices. Finally, Hendry considers himself a trend-following contrarian and says if a thesis doesn't play out over a 2-year period, he lets it go.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.